been an interesting week for the Indian currency. If you pull up a one-week chart, you see that the rupee first almost hit 73 to the dollar, and then came comments suggesting that the Prime Minister is going to hold a review meeting over the weekend where the government could consider some measures to try and protect the rupee. Couple of things to talk about here. One, are we at a stage where we need measures? Two, if we do, what are those measures? Joining us right now is Shubhada, Chief Economist at Yes Bank. Shubhada, thanks so much for taking the time to speak to us. My first question is the first part of what I was saying. Do you think we're at the stage where we need to do anything more than just verbal intervention to break this fall in the rupee?
Well, I think given the kind of risks that we see on the horizon, probably the intervention could come in the form of just beyond the forex intervention in the markets. Verbal intervention was sufficient over the last 2 days to bring in some calm in the currency markets, no doubt about it. But having said, we are still staring at oil prices, somewhere close to $78 to a barrel. We are likely to see some pressures if we see growth at 7% plus on the non-oil, non-gold imports. So current account gap is definitely set to widen to close to 3%. Our own estimate is at 2.8. That, and given the kind of risk of environment in the global markets where deficit economies, particularly the current account deficit economies, are being reviewed as a risk areas, I think beyond verbal intention we probably could do with some measures. I think the test would be what set of measures at what points in time. Very clearly, we believe that something like a non-resident Indian deposit scheme should not be the first port of call, because we do see foreign currency assets close to $380 billion, around $375 billion. At this juncture may not be the first point of action that is warranted. Yes, in last 2 days with just verbal intervention, rupee has corrected, or rupee has become stronger by almost close to 0.8%, which is a good thing because the speculative element that was creeping into the rupee trade has become somewhat contained in today morning's trade. But it's early days yet. We would like to see how it plays out in terms of the balance of payment dynamics in the current account dynamics, because basis macroeconomic fundamentals, the recent weakness in the rupee has been more in conjunction with what's happening in terms of the external sector. Compared to last year's 1.7, as I said, we are going to see close to 3% or 2.8% of current account gap. More importantly, the funding of current account gap is that of a crucial importance. We are likely to see a balance of payment deficit in the current year, which is going to be after a gap of 6 years. 2012 was the last we saw the balance of payment into a deficit. That is what it implies is our capital flows, dollar capital flows, are going to be slower than the current account gap that we see at $78 billion. Foreign direct investment, non-resident Indian deposits are tracking well, but the concern has been on portfolio flows, which remain more on the withdrawal mode. After a brief respite of July, August, we've seen a resumption of those outflows in month of September. Altogether, barring US, other developed market economies are still grappling with growth. US is growing and growing finely, and that also becomes a little bit of concern, because then the interest rate expectations in the US have become more solid in terms of at least 2 for the rest of the calendar year, but may be 1 additional, though there is no such market expectation there. Okay. So all said, there would be measures beyond verbal in terms of intervening in the markets.
Okay, Shubhada, hi, this is Harsha joining in as well. Your policy prescription, or what the government could do as policy response linked to the level of the rupee is well taken. But you've not heard any noise from the government so far that this is a crisis. And that you've got to take action. You are seeing the Prime Minister calling for a review of the economy. It's only being called as a review. At what point do you think some of these suggestions are likely to be taken seriously? In the sense, we're not in a 2013 kind of scenario, are we?
Yeah. No, no, definitely not. We are far, far removed from the 2013 kind of a mayhem. Growth is better. Inflation is half than what we were looking at in 2013. The major macros are in shape. Foreign currency assets are adequate. So we are nowhere in, as you rightly put it, we are nowhere in crisis situation. But nevertheless, it is important to note that from here on, where do we see the rupee heading to? Now, are we looking at rupee heading from 72 levels today? Of course, it's below around those levels. If it is at 73, 74 levels, given once again if there's a resurgence in oil prices or Fed talks once again extremely hawkish, what has happened to the rupee then? Probably it could see, if it sees a level of 73, 74, RBI and the government could explore varied measures. The first would be the currency defense that we look at. Typically, most of the analysts, which were largely on hold for the rest of the year, are now actually, including ourselves, looking at a possibility of rate hike in the forthcoming monetary policy of a 25 basis point hike, or if there's a strength in resurgence, nobody is ruling out a 50, though our in-house expectation is it's going to be a fluid situation, wait and watch on the data. But 25 basis point has become very active on the radar as far as RBI action is concerned as a currency defense, because growth inflation dynamics will not prompt a rate hike. The narrative will have to change. Narrative will have to be more of the macroeconomic stability, which would prompt a 25 basis point rate hike, no doubt about that. However, if there is a further pressure on the currency because of the global concerns, there are plenty of those concerns. They come through economics or the geopolitics of it. So if we see a rupee heading towards 74, 75. We could also see, oil swap windows getting activated. We could see end-use norms for, ECBs getting relaxed, some relaxation of FDI. And as I was saying, that if it really triggers a level well above 74, then we could probably see an NRI. But that would be how quickly we see a depletion in forex reserves. As I said, even today, we are at a close to 9 to 10 months of import cover, which is comfortable. So no crisis-like situation there. But however, if RBI's forces hand to intervene more aggressively going forward, and if we do see, dollar inflows getting fewer over the next few months, only then we could see an NRI deposit kind of extraordinary scheme like this. Though this is not a probable scenario, but these are the probable options that one could consider if we are looking at a further depreciation. But I would quickly like to add that all the pressure on the currency has been front loaded. That is, we are saying that balance of payment deficit was very evident in the first quarter. The data has showed that 2.4. Going into the second quarter, which is the ongoing quarter, we are continuing to see a balance of payment deficit. It's currently tracking somewhere close to 1.5% of GDP. So a large part of the pain in terms of wider CAD and lower capital inflows has been witnessed in the first half of the current fiscal year, which has quickly translated into the rupee pressure. What do we expect going forward? Probably not a deficit to that magnitude. Overall deficit, yes, but incrementally the deficit magnitude is likely to shrink, and as a result we could see a contained path of rupee depreciation and expectations not getting unhinged. And that is a critical thing where the government intervention or the central bank intervention becomes critical. Market expectations need to get anchored, and that is where some of the policies, as I said, rate hike could be the policy that we could look at as early as in October. We do not expect that inter-policy before October is likely warranted, but suffice it that it happens in October.
Okay, that was going to be my last quick question, Shubhada. You've partly answered it, but some of your friends in the economist fraternity are saying, there could be some justification for sort of an emergency rate hike. I don't get that. I don't understand how that would happen, particularly in an inflation targeting regime, where the governor has said that, look, our monetary policy is driven by inflation and not by exchange rate.
Yeah, absolutely. No, I really do not think, and that's the reason I said that narrative will have to change for the Reserve Bank of India, because this is going beyond the dynamics of growth and inflation. Inflation in particular, inflation has been printing lower headline numbers. What the justification could come from is inflation expectations. Because of the crude oil prices, household surveys may present higher inflation expectations, not high enough to warrant a 50 basis point hike, but somewhat. Pressures like on core inflation could get cited if indeed RBI is presenting itself to a rate hike situation. So the narrative clearly has to switch from inflation to macroeconomic stability, and given the kind of inflation targeting mechanism and regime that we have, the Reserve Bank of India will also need to change its stance from neutral to a tightening bias, if indeed it does go and rate the hikes do materialize. But it would be very closely watched as to what is the justification and rationale that RBI presents. On inflation front, headline CPI may not present the case. As I said, inflation expectations and core inflation pressures that could resume, that can form a justification, but to which I recall the Reserve Bank of India actually stating that they are governed more by the headline CPI mandate rather than the core component mandate of CPI inflation. So it would be extremely interesting to watch out what rationale is presented by the central bank if it indeed raises the rates on October.
All right, Shubhada, we'll leave it there. Thank you so much indeed for joining us today with your views.